The final example we need to plan for with bad and doubtful debts is example number 3. What do we do when an account receivable who goes bankrupt actually pays some of the amount owing? But it doesn't matter because we are always going to follow our 3 steps of the income statement approach. Step 1, fill up the tank for this period. So we fill up our allowance for doubtful debts. Step 2, use the tank when needed. So when an account receivable is actually declared bankrupt, use up the allowance that we need. Step 3, refill the tank up for next period by increasing its balance to the amount that we need. So that's just a generic example here. But what about if, let's take an example now where an account receivable goes bankrupt but actually decides to pay some of the amount owing? Well, step 1 will still be the same. We will fill up the tank for this period. On the 30th of June, make an allowance for doubtful debts of 4% of $100,000. So that would be $4,000. So we will do a debit. We always debit the expense on balance day. So that increases our expense called bad debts. And what that does is it increases an allowance for doubtful debts, which is a negative asset. So when a negative asset increases, that's a credit. So our tank has now increased to $4,000 of an allowance for doubtful debts. We don't think out of all the accounts receivable that owe us money, we think about $4,000 of that just won't be recovered. Step 2, make an narration, allowance recorded for doubtful debts. Step 2, use the tank when needed, just like we do on all the other steps. All we're going to do here though is say we did plan for $4,000 of doubtful debts, but what happens if an account receivable, in this case Elaine Bennis, is declared bankrupt, but out of what they owe, they're going to pay $1,100 off their account, which is $3,300. So they owe us $3,300 and it's made up of a $3,000 sale plus $300 GST, and they'll pay us $1,100 of that, and the rest is a bad debt. Well, it seems like there's a lot going on here, but we're just going to break it into kind of 2 mini steps, I guess. And so the first thing is, I'm actually, as a business, going to get some money today. I'm going to get $1,100. So that would increase bank. Bank is an asset, so that would be a debit increase of $1,100. And that's really the only thing that's kind of different, because all we're going to do now is do step 2 just like we did in the other examples. I'm going to use up my allowance. So in this case, how much do I need to use up? I've allowed for $4,000. Well, let's figure out how much I'm going to write off here. So she owed $3,300 here, and she has paid, it says $1,100. So I need to write off a total of $2,200, but $200 of that, which would be the GST. So what I should do is use up $2,000 of the allowance for doubtful debts here, because that is the amount of the sale that she's going to be writing off, and then I'll write off $200 of GST for a total of $2,200. So all I did was I made an allowance in step 1 of $4,000. I just used up $2,000 of it, so that leaves $2,000 still in there as unused. And all that happened was, if we add up these 3 numbers, we got, so Elaine Bennis owed us $3,300. She paid $1,100. We used up our allowance of $2,000 for doubtful debts. We wrote off or decreased the GST by $200. If we add up these 3 numbers, we're going to decrease accounts receivable, which is an asset, so it's a credit, by the total of these 3 numbers, which is $3,300. And that logically makes sense. She owed us $3,300. How much does she owe us after today? Nothing. Why? Because she paid $1,100 here. We wrote off $2,000 of her debt as an allowance for doubtful debts. We took it out of our allowance, and we got to decrease the GST owing of $200. And if we add all those up, it comes to $3,300. The actual debits and credits from this line down are the exact same as they were in all your other examples. What we might do is just maybe change our narration. So I've just written account Elaine Bennis written off as irrecoverable. Maybe we just say also how much they paid, paying $1,100. Step 3 will be the same. Let's refill the tank up for the next period. So step 1, we filled it up with $4,000. Step 2, we used it when needed, so we used up $2,000. So that left a balance of $2,000 here. And at the end of the next period, which is July, we think 5% of $80,000 in net credit sales will be a bad debt or irrecoverable or won't pay in the future. So let's do 80,000 times 5% is 4,000. So we need to get this tank back up to 4,000. But at the moment, it's only got 2,000. So we do exact same debits and credits we did here. We debit the expense, called bad debts, of 2,000. And then we credit our allowance for doubtful debts of 2,000. And all that does is it increased it here. So now we can see there was $2,000 unused. I just put in another 2,000, and that came to a total allowance of 4,000, which is exactly what I needed it to be. So that's another really tricky example where an account receivable goes bankrupt, but they actually do pay an amount, and the only tweak we did was here. But remember, all we're ever doing, no matter what example, is just always following our 3 steps. So make sure you know the 3 steps, and really there's no example that you can't answer on an assessment.